All right, good morning and welcome to Yahoo Finance's morning brief on this Masters Thursday. I'm Miles Hubland. That is Julie Hyman, wearing green, appropriately, of course. You were dressed for the occasion.
I don't know what occasion that is.
Well, that's good. Let's start with the markets here. Pitch me. Tell me why this is a hot market, Julie. Futures down 0.3. Rush of data this morning. GDP data, third estimate for the first quarter. PCE data out this morning. Yesterday was exciting in markets. Today, yes, leveling out. I guess I'm curious, 24 hours in, what you make of the place?
I mean, it's kind of what we said yesterday, right? Like, maybe the bottom is in, and from here we'll kind of yes, yesterday was exciting, but from here we'll kind of bump along. And that's kind of what's happening, right? That we'll have this volatile environment that people will react to. Oh, maybe the news that the ceasefire is not all that it seems, but are we going to backslide back into where we were? Are we going to backslide into a rain of fire down on Iran? Probably not in the near term, knock on wood, who knows? But, so we just sort of muddle along with what we have. And maybe earnings season will change that. I don't know. But earnings season didn't really change anything last time.
No, earnings season never does.
It was very company specific. And I think that it will continue to be very company specific.
Yeah, earnings season is actually an intra-earnings season event because that's when the estimates come out, and then the results are one thing.
Yeah.
Go ahead.
I would say this, now that the war's over, as we talked about, do we get this reset to where we were? But then the next question is, okay, and what are the other big catalysts out there? It doesn't feel like we have any yes, we've got inflation data coming, but we had some inflation data today, but it was dated from before the war. So I don't know what that next big thing is.
Yeah, I was thinking about it this way in terms of not less what's next, but more what to make of what just happened.
Okay.
Specifically around Trump-related headline risk, taco trade, whatever you want to call it. And I feel like we now have, that has come out of the market for now, and I think is set to be significantly less potent going forward. Of course, barring surprises, but the way I'm looking at it is, last year we had the big surprise of all surprises, Liberation Day, where it was we thought Trump was going to go one way, he went another, eventually backed off, birthed the taco idea. Stocks went down about 20% that time around.
Right.
This time around, similar idea of the kind of speed with which we moved into Iran, the scope of it, that was all surprising. People were like, whoa, what's going on? Market went down 10% this time. Now that's kind of come out of the market. So I think whatever the next surprise is going to be a 5% decline, and then 2.5%. I think there's a decay here on how much surprises, not related to, I don't want to say geopolitics or inflation or other things, but related specifically to President Donald Trump surprised U.S. investors with X.
Right.
That magnitude of surprise and how much markets are going to react to that has halved in a year, with a surprise that I kind of feel was actually of the same magnitude, and we can go through economic impact, blah, blah. But I think they were similar in terms of the scope of the surprise, and the market reaction was half the size this year. And I think that's, to me, the carry forward here is the dynamic around how Trump himself introduces risks into the market has become a less potent part of the market from here till the end of his term.
And the other side of that lesson over the last year is also what we always talk about, which is stocks go up. In other words, if you are a longer term investor than a day or a week or a month or 6 months or a year, and you bought on Liberation Day, you would be in good shape. It's that these shocks that he has introduced into the system are emotional shocks, perhaps more than anything, chaotic shocks more than anything, but market shocks, to your point, to a lesser degree. And so if you were an investor, your lesson would be buy on the shock, probably.
Buy on that shock. Yeah, because the other thing is, this is not to say that there can't be other surprises in the market. Or the last time we had a really long downturn in the market, it wasn't, Trump wasn't the president, right? And it wasn't related to things coming from a political direction necessarily, or at least a U.S. domestic one, right? Because it sort of catalyzed by the Russia-Ukraine war, but then it just became this whole inflation cycle, higher rates, bad for tech, so on and so forth. I'm not saying that cycle wouldn't be or couldn't be repeated and wouldn't have, the same kind of deleterious effects for the market, but the idea that the source of the market's angst from this point forward will be, call it, I don't want to say Trump's whims, because they're not quite whims, but just like his unpredictability, which I think is a clear feature of his, political life. That just seems right now like a thing that going forward is going to be a less potent impact on the market, like on a headline basis, right? On how much the S&P goes down. Because again, we've gone 20, we did 10, and I just think that, to me, if you want to do a path forward, it feels to me like that's, whatever. I'm seeing a graph in my head, and it kind of gets, whatever, less.
I see.
You know what I'm saying?
I can envision that graph,
right,
and that graph diminishing effect.
I guess I have to draw it the other direction because I'm kind of the way the camera is, But I am seeing it from my left to right, but I got to go this way on the screen. So.
And what you're saying, yes, it makes sense. But you still have other risks out there. You still have. I thought it was really, as somebody pointed out yesterday. In the Fed minutes that just came out, the word transitory wasn't in there because they sort of learned their lesson of 2022.
Yeah.
Those risks are still kind of present and percolating.
Well, I think maybe the last thing on this, and it's funny, I was like, this morning when we talked at 6 o'clock, I was like, I have nothing to say on the market. We've done 6.5 minutes here. The other lesson of that.
This is not the first time that's happened, Miles Edlund, by the way.
This might be my bit. The other part of that is, I mean, maybe this is sort of what can be frustrating at times about, let's say, this position in the market. Like, what's happening today? Let's talk about it.
Yeah.
Those sorts of things on a durable, like how do they create durable downdrafts in the market? Almost never hold. It has to be these bigger structural shifts which kind of are playing out over time.
Right.
And that like much more slowly, like it's not,
and
the market going down
those are much more difficult to spot.
Well, right, and it's not a distinct break. That's the problem, right? Because it's not a distinct moment in time. And so, maybe that tees up the next kind of discussion here, next discussion point, which is another perhaps cyclical move happening in slow motion, which would be private credit generally. Continuing to see this week, to me, a couple different stories on it. Goldman Sachs talking about looking for their opportunity. Story in the Journal this morning. BlackRock touting their, kind of positioning within the private credit space. Feels like we're opening Q2 from the financial sector with a couple different offensives, PR offensives, to remind investors who may have either pulled funds or didn't and are nervous about it that we've got this. It all seems fine.
Well, and the flip side of it is that the narrative seems to be there is a problem, but it's not us. It's in software. It seems to be that there's this sort of walling it off, that it's in software. I mean, this is something I talked to Torsten Slok about earlier in the week, that the yields on software debt are much higher than they are for the rest of that private credit market because people want that yield to take on that additional risk. And then Bloomberg has a long piece today with a lot of different charts looking at software credit and private equity for that matter versus the rest of that market, and that's where the risk is concentrated. So if that's where the risk is concentrated, then can it be contained, right? And I still haven't seen anyone argue that it won't be contained, right? That this is some big systemic risk or even small spillover risk. That kind of has died down to some extent. But it's still reflected in the stocks of these companies that hold this stuff.
I think it does beg the question of like, what is containment, let's say?
Sure.
Because yes, I think I don't think it's super hard. Like, I don't think you have to buy, hook, line, and sinker, the industry's line on how great this stuff is, to also be like, it's probably not going to take down the entire financial system. Right? But
there's a big space in between those.
There's a big space between those two. Yeah, for sure. And I don't think that anyone who works at a major private equity firm who is being rewarded in company stock in part is going to be super happy. The stock down 40%. That's not going to feel like containment necessarily at a certain point. But I think I do sort of feel like, Blue Owl to me right now, and I don't know how I think they have to wait. All they can do is just like hang in there. But no other firm comes out and points the finger at them specifically. But like, I read all these stories from whatever player it is and whatever executive it is coming out in the media being like, we think it's fine, opportunity, yada, it's contained here, yada. What they're not saying is, it's a Blue Owl problem. That's not our problem. This is those guys. Those guys are the ones that have become the brand that investors, the media, the investing public, those who are not fully sophisticated on the nature of what these investments are, the thing in your head right now is like, oh, blue owl. And I think that'll be an interesting dynamic to see how that plays.
Well, I mean, and for people who are not super steeped in it, my understanding is the difference between blue owl and an Ares or a Blackstone or a Carlyle is that blue owl is much more of a pure play within credit. They do have some other investments, but they're much more a credit shop than some of these other firms, which have
private, smaller firm,
private equity, restructuring. You know, it has built its name as a credit shop, kind of specifically, whereas the other companies are more sort of private or alt assets more broadly. And so I think and it is smaller. It's a startup, effectively.
Yeah, I mean, there was a need in the market for this kind of capital. They filled the need. That's how they got so big so quickly and why they've been so successful. But now, you know, and that's what, a 10-year story, basically, a little bit less than. But now it's sort of like, oh, maybe this is the first test, really, of the cycle.
Yes, and I think the other thing is, you know, if we are, whatever this year is going to look like, I think most economists think that, you know, growth is not, they're not looking at growth heating up in a significant way from here. And so in any credit cycle, forget about software, just looking at the economic cycle. If the economic cycle is not as strong, the credit cycle is probably not going to be as strong, and you might see an uptick in default. So we'll see if that how far that spreads. Does it go beyond, you know, how much of a problem is that? Are these companies prepared for that to some extent? Usually they would be, right? Because it's a normal cycle. So we'll see what that all looks like.
I guess like the challenge, I guess the challenge that I'm having with this is it's not, like we're not really talking about the investments though. It's mostly about who has invested in these things and how that investor is behaving. So like I think
recently, yes, yeah.
Right, and so that is where I think if I'm one of these companies, I actually, like that's kind of a nightmare, right? Because you're dealing with essentially unhappy customers in a way. But you also feel like nothing about this private credit disruption has actually upset your model. You're like, well, we still have made the investments that we believe in.
Yes.
To your point about defaults.
That has been the line.
I just don't, you know, I don't know. So I think that is, it's just an investor psychology moment in a lot of ways, and I don't want to say just like to downplay it, but I think that's what's interesting is how, if at all, you're able to sort of steady an investor base that maybe you weren't 100% sure you wanted to take on, but you did, because it's, you know, essentially like a high net worth. We call it retail, but it's like, you know, it's rich-ish people, you know, kind of, and how they're, you know, behaving through this cycle. So I think these firms would love to talk more about their default rates, frankly. They want to talk much more about their default. Absolutely, absolutely.
Yes, I guess I'm saying I think they'll probably tick up a little bit, but not like in crazy fashion.
We haven't had a default cycle. Like when was the last like default cycle? 2018?
I don't know.
When this industry was basically founded, right? It was like
they were taking
when rates went higher, when rates went off zero for the first time, you had kind of like a frozen loan market in that 17-18 period, and then Powell backed off that, and so now you created private credit out of that moment, and now we're here. Kevin Warsh is going to raise rates, so you extend and pretend.
There you go.
There you go. Okay.
All right, I want to talk about another couple of companies, I guess. CoreWeave and Meta. They expanded their deal this morning. Yeah,
tangentially.
I mean, yes, tangentially. It's
all one story, as Sam Rowe used to say.
They already had a partnership, right? So now $21 billion is the new partnership between these two. I find the whole like neo cloud space, as it's been dubbed, pretty interesting. CoreWeave is a part of that in the sense that like they're not the hyperscalers, right? They're sort of like leasing some of their data center space. In some cases they own it. CoreWeave is trying to own more of it and lease less of it. But you know, part of this whole data center ecosystem. I was looking earlier at CoreWeave's stock price because this is a relatively recently public company, right? It only went public in
75?
March of last
90.
year.
It's right there on the screen. Yeah.
It only went public in March of last year.
I know.
It says, and
it was like what, $190 stock in June, something like that.
But the IPO price the split adjusted IPO price is 40 bucks.
Yeah, right. Yeah.
So yeah, it's come down off its high a lot, but I guess I didn't realize how far above its IPO price it still is. And so there is this belief in these neo cloud companies. There's Iron, there's a lot of the Bitcoin miners that have pivoted to this that are in that space.
Yeah.
So it's done better than I thought.
My take on this, considering that they already have an existing agreement, and this is an expansion of the agreement, in the context of both Meta's model announcement last week, the Anthropic cycle, multiple OpenAI stories, but the press release economy is really back. And that was a big thing.
Did that go somewhere?
I think, well, it became like the Trump tweet economy, I guess, in March, right? But like, January, February, it's like every tech, this actually goes back to last year.
Oh, I see what you're saying. It's back like after the war pause, you're saying.
Yeah, it was just, once it became a meta, not a meta platforms, but like a meta of the market that you could announce a press release and your stock would go up and you'd get some kind of positive reaction, no matter the significance of it. That came out of the market a little bit because private credit was bad, right? So those press releases are bad now. Then you have the war cycle.
Right.
But I look at the flurry of announcements this week. There's like a whole corporate strategy part of this too that I don't want to diverge into, but I find very interesting. But you see the announcements this week and it's like, oh, you get those press releases going. Get the comms team going. Let's get the ink going because there is a receptivity now in the markets once again. It feels like you have a partnership, restate it.
Right.
Slightly expand it, restate it. Let everyone know you're doing this thing.
And by the way, speaking of private credit, you know how CoreWeave is going to fund this build out? Not private credit, but the public markets. But its debt is junk rated, because it is viewed as higher risk. So they're raising $1.25 billion. They're selling that much of notes that are junk rated in order to fund this build.
I'm surprised junk hasn't more successfully rebranded.
Well, high yield.
Exactly.
High yield. Excuse me, it's high yield.
But I think everyone knows what you're talking about. Everyone knows what you're talking about.
And also in the chip space. So we talked earlier in the week about Jamie Dimon's annual letter. Andy Jassy out with his annual letter today to maybe less fanfare, but his letter is much more focused on Amazon and much less focused on like the state of the world. But skimming through his letter, the one area that I really thought was interesting was when he talked about the chips business at Amazon. Because a lot of his letter was sort of reflecting on the history of Amazon and how they have pivoted and how they try a lot of different things and only some of them work. And so now he is talking about how big their chip business has become. He gets in a little dig at NVIDIA, I thought, where he was sort of like, of course we're always going to provide NVIDIA GPUs.
I didn't see that as a dig, but I'm looking at it right now.
Sometimes our customers are going to want more cost-effective chips.
Yeah.
And that's where we step in with our Trainium chips. So I thought that was, maybe it wasn't a dig, but it's just a statement of fact that NVIDIA's chips are expensive and theirs are less so. But I did think that was interesting. And he talked about the size of the business as well.
Well, I know Amazon, I don't think Amazon thinks of themselves this way, but I remember Brad Stone's book, The Everything Store. And this has ported into all kinds of other businesses. And that's essentially, Jassy sort of goes through that line of thinking in a way in this letter, and as he winds up to the chip part of it.
Yeah.
But the Everything Store of like, we will have a solution for you. Oh, you need lower powered compute? We will offer.
Yes.
We're not just going to offer that. We are actively investing in that solution for future customers. It's very Amazon, very consistent to, what that company, I don't want to say has been, but like what they became in that post AWS. That's 20 years ago now.
Yeah.
But like in that post AWS world where they started to really see that they could be like, let's call it a brand. They're like a branded generic. That makes sense, right? Because AWS in a lot of ways is sort of, it's not totally a generic service. It doesn't work quite the same way, but it's kind of a branded generic, I feel like.
I buy that. I buy that.
So at any rate, I did, and to your point about the difference between this and Jamie's letter, I prefer this style.
Well, and you even said that when the Jamie Dimon
deeper
letter
into the strategy of the company, because then, to your point, bringing up the NVIDIA part, there's just a little more that if you were a strategist or an analyst, or you were trying to kind of glean something from Amazon out of the letter, there's a lot more, like you're not getting a ton of corporate structure lessons out of the JP Morgan that Jamie Dimon's describing in that letter, whereas I think there's plenty in here to kind of go through on the Amazon side. But one thing I did want to note that I found, which this is maybe the least serious thing that was in the letter, but that I found amusing personally, was when he was like, we're not investing approximately $200 billion in CapEx in 2026 on a hunch, which on the one hand, fine. On the other hand, has a little bit of the, my t-shirt answers the question many people are asking sort of ring to it. Like, just so you guys are aware, I wasn't making up that we had a $200 billion investment opportunity in front of us. I understand why you say it, but it's also like, did you needed to say it? You needed to let everyone know it wasn't just a vibe?
Well, and no, but like, and that also misstates the question. The question, because we've been discussing this, in other words, like, we know it's not a hunch. But is it something that that is being shoved down everyone's throats that they don't necessarily want?
Yeah.
So the hunt, it's not like we think you're doing it on a whim.
Yeah.
We think you're doing it when when like the end user, that is the workers of America, don't necessarily want it. So it's two different things.
Okay, so what's interesting though is that's not the direction, like the response essentially to that call that Jassy makes is not the response though. It's not about that. It's about we're investing because we have the commitments from people that we're gonna backfill it on our income statement, I guess, or the balance sheet, I guess is the way you'd think about it. But yeah, and then it kind of goes into like, you know, when we see the growth in the when we see free cash flow and an opportunity growing near term, we're actually going to invest more aggressively into that, which again sort of answers the question which continues to come up across all the hyperscalers, not just an Amazon thing, which is, okay, you guys are throwing off tens of billions of cash, and now you've decided that you want to actually take on tens of billions in debt after spending all the free cash to go invest in this thing. And you know, he puts a time frame on it. Much of this investment will be monetized in 2027, 2028.
Yeah.
So these companies believe they have the visibility and they believe they will show the results. Yeah. So I know we just sort of, I don't want to say I poo-pooed earnings season, but I downplayed it slightly. I guess we're going to get more of that kind of messaging though over the next couple of weeks of, hey, next year and the year after, that's when we're looking.
Well, there's downplaying earnings season for like the big picture.
Yeah, we
wouldn't downplay it for the individual companies. All right, we have like 3 minutes left. Can we talk about Satoshi for a hot second? Okay, we got 1 minute left. We'll talk about
promo.
So so the New York Times, John Carreyrou, who's a sort of prestige journalist who wrote Bad Blood, the Elizabeth Holmes
broke the Theranos story.
He now has decided to set his sights on Satoshi Nakamoto, who is the mysterious founder of Bitcoin, who wrote the white paper that Bitcoin is based on and then disappeared and nobody quite figured out who he was. He says it's a guy named Adam Back who is in that world. He's the head of a company called Blockstream. He did all kinds of analysis of the guy's language in various writings and concluded he's not the first person to point the finger at this guy.
Yeah.
And Adam Back says, it's not me, by the way, and he has said that before, but there remains this fascination within that community. I'm going to talk to Adam Back later today. And again, we're going to talk about whether or not he's Satoshi. He says he is not. And we'll talk about other stuff besides. But I just think, you know, it's just so interesting to me, this sort of enduring fascination with this character and who this person is.
Right.
Because the person also apparently
many such characters in world history.
Yeah, yes. I guess eventually, there are many such characters. Do we always find out who they are? The mysterious figures of history? I don't know.
Do I want to do all of religion in 30 seconds? I don't really want to do that.
Right. So I don't know if we'll ever figure out who this person is.
I guess I would just, only thing I would say, I'm not sure. I don't care. I don't think it's important for Bitcoin that we find Satoshi.
I think Adam Back has the same exact view on that.
Yep.
So we'll talk about it.
All right, cool.
Later on, 10:30. All right, that does a morning brief. We got much more coming up. Opening bid is next with Brian Sazzi.
Good morning to you, Yahoo Finance community. I'm Yahoo Finance executive editor Brian Sozzi, coming to you from our New York City headquarters. Here's what's on my mind right now, and it is a lot, so bear with me. Meta's new Muse Spark model is getting lavished with praise by Wall Street. I get it. Really, I do. But here's the rub. Zuck has spent gazillions to buy human beings to develop this crap, and this model is still below the capability of ChatGPT and Claude. In fact, he has taken time away from his precious windsurfing to secure this top talent, and still, it's not up to par versus rivals. So maybe Wall Street needs to chill out on this one. More on this in a news story I just dropped on our homepage and our app moments ago. And in keeping with my angry vibe for today, markets are still feeling good about this 2-week U.S. and Iran ceasefire. Veep is slated to lead talks on Friday, but here's the thing. Ships are still not ripping through the Strait of Hormuz, and oil prices continue to be elevated as a result. Temper the optimism on this, all ending super well 13 days from now. The clock is ticking, friends. Lastly, Constellation Brands joins Delta this week in striking a cautious tone. Constellation Brands, the U.S. maker of Modelo and Corona beer, withdrew its previously issued fiscal 2028 outlook late Wednesday and reports slightly weaker demand as consumers navigate high prices seemingly for everything. If these two reports scream bull market back on for stocks, maybe I need to go back to being a golf caddy. Maybe I can caddy for Tiger when he returns to the Masters in 2027. Here are my opening bid roundtable. Keith Lerner, Truist Chief Investment Officer and Chief Market Strategist, alongside Yahoo Finance breaking news reporter Jake Connolly. Jake, hot hand goes to you here. All things oil, very much in focus for these markets.
Yeah, Brian, you've seen a lot of action, even just over the last 24 hours. Remember, we're still less than 48 hours away out from when President Trump initially announced that ceasefire agreement. Now, you look at some of the shipping data. You were mentioning the Strait of Hormuz there. According to S&P, only 4 ships have crossed on Wednesday. Reuters reporting that 5 have made the crossing. Only one of those was an oil tanker. This is also far below the levels we were seeing even just a few days before. So it shows you this is not easing up as the White House was hoping. You've seen Vice President J.D. Vance coming out and saying that they're not going to move forward if the strait's not open. Iran saying that the U.S. has violated the ceasefire agreement, citing the attacks in Lebanon by Israel, citing the U.S.'s demands that Iran will give up its nuclear development program. These are all red line issues for both sides, and it's only getting more complicated seemingly ahead of talks beginning in Islamabad, Pakistan on Saturday. In response, you've seen the oil markets ticking back up. Brent crude up more than 4% this morning. US WTI up more than 5%. The market's not really sure what to make of this. From what I hear from people I talk to on the ground in the area, strategists I talk to, until there is real convincing arguments that ships can make that crossing safely, we're going to sit in this unease for a while.
Yeah, Jake, you look at that market action yesterday, you would think everyone was suddenly thinking we're going to get hundreds of ships going through the strait, life is back to normal, and oil prices going straight back down. But Jake, let me just stay with you for a second. Goldman Sachs out this morning with a note, sticking with their call for oil prices. Once things subside, to end the fourth quarter around $75 a barrel. Does that sound about right to you if we do get back to some form of normalcy?
If we do get back to some form of normalcy, I think so, but that is a big if. All the strategists I talked to have pointed to that if this does open up, if those 800 tankers that are stuck on either side of the Strait of Hormuz can start moving again, we could see some significant rebalancing down in oil prices. That said, the bull case for oil right now, let's say this lasts through April or through June or further into the summer, we could be looking at $100 a barrel oil through the end of the year and possibly even into 2027. This is a huge if right now for the market. And again, everything I keep hearing, the market needs to see ships moving. Action is going to speak much louder than words here.
Keith, that was good to see you, my friend, as always. I was thinking back into today, how much did I ever spend this much time thinking about the Strait of Hormuz in my life? I don't even know if I talked about it in high school, Keith, but this remains very much top of mind for the markets. And you, my friend, came out and upgraded the energy sector, right?
That's right. Well, hey, always great to be with you. Hopefully I can cheer you up a little bit.
Yeah, cheer me up. That's why you're here.
I'm a little bit. Yeah, so listen, I would say more broadly on the market, last week, our indicators got pretty oversold. So we started to tell our investors that the risk reward was improving somewhat, even though there is a lot of uncertainty. But then yesterday, when oil went down about, the energy stocks went down about 4.5%. We took that as an opportunity to upgrade energy for some of the reasons that were just outlined. We think energy will likely stay somewhat elevated. We still have an overweight in areas like industrials and technology, but this is where it's going to be somewhat messy. And if it does escalate, you want to have some hedge within portfolios, and we think the energy sector does that. Now, Brent, I will also just remind us, this is the 1-year anniversary of that almost 10% pop on the tariff pause last year. I expect things to be messy, but the other thing to just keep in mind is markets tend to bottom when there's peak uncertainty. If you wait for clarity, full clarity, the market's already moved.
Do you think the bottom is in the market for the year?
I love when you test me on those type of questions.
That's why you're here. I can't ask a lot of people this, but I know you get it. That's why I'm asking you.
Yeah. Well, I'm gonna provide a little bit of a hedge as well, since we're talking about energy. Listen, the way we're thinking about it is at the recent lows, we said the risk reward has improved. We didn't see full capitulation, so I can say at this point with high confidence that the low is in. But I think at least the risk reward has improved. At least expectations have reset. At least the valuations for the market, which aren't cheap, have reset 15%. Technology valuations back to the lowest since 2023. And the way we're thinking about it is averaging now, if we got something that was a little bit deeper, say, closer to 6,000 to 6,200, we'd be more aggressive. So we're thinking more risk reward as opposed to trying to call tops and bottoms, which is cute, but really a challenge to do.
Fair enough, Keith. Let me just, on your call with energy, what does that precisely mean in the most simplest of languages? When you come out and you upgrade energy, is it a signal that moving forward, energy will outperform the S&P 500? Is that how you think about it?
I think in two ways. One, we do think that it will likely over time, not necessarily the next couple of days, the next couple of weeks, but let's say over the next 3 to 12 months, there's a good chance it will outperform. But more broadly, too, going back to basics of diversification, if we're overweight industrials, which is dependent somewhat on the global economy, if this thing escalates even more, and let's say our base case for the economy that we think is solid slows down, this provides an offset. So I look at it as holistically, but to your point, energy hasn't done anything for about a decade. It's only up about 50%. It's trailed the market by a huge amount. So we think there's still upside relative to other sectors as we think about the year ahead.
Jake, I think Keith brings up a good point here on energy not doing much the past decade, which I do find surprising, because Exxon, Chevron, a lot of these companies have cleaned up their finances, whether they were under attack from activist investors, whatever it is. In many respects, these are different companies compared to a decade ago. They're generating more cash, and I would say they've been a little more shareholder friendly too.
Yeah, I think that's right. These are highly stable long-term businesses. You think of energy as a defensive sector. You talk about Exxon, you talk about Chevron. These are companies that are reliable. They have the model in place. They have the numbers to support that. And I think investors kind of took a back seat on energy, thinking these are stable stocks. Now, obviously, into 2026, the best performing sector in the S&P this year, as energy has become such a story. You also have to remember, for coming into this year, we thought the oil market was going to be deeply oversupplied. We were expecting oil prices to moderate down throughout the year, certainly not crossing 100, which has pumped a lot of energy back into these stocks. You and I, Brian, were talking yesterday about Exxon. Their global oil equivalent production is going to take a 6% hit on the first quarter, but they're also getting the bonus of getting to sell their products that they do have at the higher price points that these elevated prices are allowing them. Chevron is also going to get that bump. Shell, BP, ConocoPhillips, all these companies are going to benefit from these higher prices and probably keep at these more elevated valuations, keep moving forward, at least as long as these oil prices stay in the sector and in focus for investors.
Keith, I really don't agree with that Goldman call that oil is going to magically go back to $75 a barrel by the fourth quarter. Maybe it will, maybe it won't. Unclear. But I do think there is going to be some form of war premium that is going to stick around in oil prices for at least 6 months, if not longer.
Yeah, I agree with that. I also think if that's the case, then the earning estimates are likely to move higher, and therefore the valuations, which do look a bit rich right now, probably aren't as rich because those earning estimates have upside room as well. So that's another reason behind the upgrade.
I have a good chart, Keith, on the Mag 7, and sentiment on the Mag 7 ahead of earnings. I mean, it's pessimistic. It's almost as pessimistic as I've seen in some time. And look, these companies have done it themselves, Keith. They're spending billions of dollars on AI. We don't yet know the return, so I get it. Are these stocks officially at that level, though, where any semblance, you see that chart right now on the screen, any semblance of positive news that they're generating returns from all these billions are going to be well received by the market? I look what Meta came out yesterday with just a model, and it's behind Claude, it's behind ChatGPT, and the stock gained, I think the company gained about $110 billion in market cap.
Yeah, I mean, Brian, we've been doing this for a long time, and it's all about relative to expectations. And I would say back in October when tech peaked, we were at a 32 forward PE. Now we hit 20. I mean, that is a 37% decrease in valuation. So there is uncertainty. There is concerns about will they be able to monetize AI or the spending. There's concerns about the debt financing. But the good news, at least the market is now reflecting some of that uncertainty in these lower valuations. At the same time, the forward earning estimates for the technology sector at RIT is much stronger than the overall market. So to your point, I do think a little bit of good news could go a long way for tech, given how much they've already compressed as far as valuations and prices.
Aren't these estimates too high, Keith? It has been amazing to me to watch over the past month and a half as this war has played out. Oil prices have gone through the roof, inflationary pressures have picked up, and earnings estimates for so many companies have either stayed the same or, believe it or not, have actually gone up.
Yeah, well, there's typically also a lagged impact, and so far, if this goes on, that's going back to the if-that statement that you're hearing a lot of strategists say. If this is prolonged, yes, you'll see estimates come down. If it's a 30 or 60-day type of action, I don't think we'll have as dramatic impact. And we also have to realize, what markets are we talking about? Because for the S&P 500, close to 50% is based on tech and AI. And Brian, maybe you'll be happy over the next week or two because we'll start getting back into earnings season. So we'll.
I love earnings season, Keith. Earnings season makes me very happy. I love the craziness of it all, my friend.
Yeah, so you'll have Iran, but you have something else to talk about as well. And I think, listen, we have to also remember in times like this, Iran certainly matters, oil prices matter, but it's not the only thing that matters when we think about the next year, next 2 years, and so forth for these markets.
Jake, I look at these oil markets today. I was watching yesterday. Just crazy volatility. And gas prices, they're likely to stay in no man's land for now.
I think so. And you see that narrative starting to come through onto the street. You have seen some gasoline analysts say that if prices can stay at these depressed levels, if oil can stay depressed below 100, we could see those pump prices that have gotten so high for Americans, crossing $4 in national average a few weeks ago, we could see that start to moderate. However, there is still such an if factor here, as we keep talking about. If this jump we're seeing this morning in oil keeps going, those gasoline prices Americans are paying aren't going anywhere. And this is coming when the American wallet is already under stress. You saw inflation ticking up this morning. All of these metrics are going to come together. If oil prices do not abate, if this conflict does not abate, you could see those gasoline prices still hanging high. And that's just going to be one more pressure point for Americans and one more thing to make the Fed's job just that much harder.
Keith, it cost me $55 to fill up my Corvette, dude. That's tough life, right?
Get a new car, Brian.
Yeah, I do need a new car. Maybe I got to downscale to a Hyundai. Keith and Jake, you both made me happy, and I needed it. It's been a long morning. I appreciate y'all. I'll talk to you soon.
Thank you.
And for more Polymarket odds, scan the QR code on your screen to go to the Yahoo Finance's Prediction Markets page, powered by Polymarket. Love this page. Straight ahead, get your notebook out because former TD Ameritrade CEO Joe Moglia joins me next to share a whole lot of investing wisdom. That's next on Open and Bid. Whenever I want to get some real insight into markets, I dropped a line to Joe Moglia. Joe is TD Ameritrade's former chairman and CEO, the former head football coach and current executive advisor to the president at Coastal Carolina University, and newly appointed executive advisor to the board of Greenland Energy. Joe, welcome back to Opening Bid. Always good to see you. Just love to get your thought on the markets here. It's been a wild few weeks. This week has also been wild. Give us a state of play.
Well, first of all, good morning, Brian. Glad to be on. The state of play, it's a little bit gut-wrenching. So, 40 days ago, or whenever it was, we start to bomb Iran. That's clearly going to be a problem. What we did ourselves, we took a look at our portfolio, and this is the same thing I would recommend to your listeners. And take a look at your portfolio and what is it you own that you know is going to be a problem. Now, we know we've got geopolitical tension, as serious as it's ever been. We know that's very much centered around energy. So what in the portfolio is going to be a problem as time goes on. So anything oil, if you don't have energy in your portfolio, it might be a good time to add something. If you have things that need energy, if you need travel, airlines, cruises, et cetera, you probably don't want them in your portfolio. But then if you haven't really done anything already, you probably want to sit pat and see what's going on. The number one thing you've got to be able to do is not panic. The concern that everybody has the other night, of course, 24 hours ago, is that this is either going to be really, really bad, and I think the market was going to go down 10%, in my opinion, overnight, or we're really going to strike a deal and we'll probably have a 10% rally. Well, that didn't happen. But we got good news, we thought. Until we woke up yesterday morning, we found out that, Israel and we are not necessarily in sync. Iran's still telling us we're not going to get through the Strait unless they say it's okay. Trump saying that's not going to be acceptable. So the confidence that we seemed to have 24 hours ago doesn't seem to exist right now. And we still have 2 weeks to be able to figure it out. But right now, the number one thing you can't do is panic. I would look at your portfolio. If you've got something that's really shouldn't be in there because of what's going on right now in the world, probably would make sense to get rid of that. Maybe it makes sense to own some energy, that type of thing. But you don't panic now.
Joe, what do you say to those folks? Because I've gotten these questions in the past 48 hours. They come to me and they say, well, Brian, I missed a 1,000-point move on the Dow. What do I do now? And they're panicking in the sense, Joe, that they are afraid of missing the next 1,000-point move, but they're not willing to take the risk of the Dow going down 1,000 if the ceasefire comes and goes.
Yeah, okay. Now, Brian, that's the point. You can't panic. And you are panicking, as you pointed out. They're being emotional. You cannot be emotional with your investments. Anything that really, really matters. Now, I'm a pretty emotional guy. I'm a pretty passionate guy. But if it's critically important, you got to use your intellect with regard to that. You can't panic with regard to the markets. You got to know in this day and age, there's always going to have tremendous volatility. If you already missed a big point in the market, it's probably because you made a big decision to either get all in or all out on something. And you can't be all in or all out right now. You just have to be thoughtful. I think you got to be gradual. You could dollar cost average. I think on weakness, if there are names that you like that are not going to be really truly negatively impacted by what's going on now, I would dollar cost average into them. If you have names that have done well, I wouldn't mind trimming some of those into strength. So you know what you need long-term portfolio. You set your portfolio up that way. You try to make it diversified, but then you trim it into strength. You don't forget about it. You trim it into strength and you add to it by dollar cost averaging on weakness. That would be a reasonably thoughtful way to be able to approach this. If you've already messed up, well, just be calm and wait a while until you're comfortable that you know what's going on. And that's still dollar cost average in.
What's your, you've had an uncanny ability when you've come on with me, Joe, of really nailing the sentiment around the Mag 7. So ahead of this segment, the Mag 7 sentiment has been weak. I mean, they're spending a lot, valuations still high, and folks, I would argue, not expecting much from these companies or as much from these companies for this coming earnings season as they were, let's say, 6 months ago. Like, what is your thought on these stocks? Do they represent a good value here?
I think they do represent a good value. Now, having said that, you hit the nail on the head, Brian. The reason why people are concerned is because there's been so much money spent on the capital expenditures, and it's all AI related, data center related, data power, et cetera, et cetera. That's a lot of money. Now, I think the people that run the Mag 7 know what they're doing. I think they're really pretty good. It's not an accident those companies are called the Magnificent Seven. They're the biggest companies in the world. They have tremendous balance sheets. They've been incredibly successful. I'd rather bet on them that they're right in the amount of investment they're putting in than analysts that are observing this and are getting nervous about it. I think with the way they've come off, I think they are worth buying. I think they are worth owning. If you own them, I certainly wouldn't get rid of them. And here's where I think you could put in that dollar cost average concept. If NVIDIA and all the respective names are significantly below their highs, to be able to dollar cost average this month and next month, maybe you buy a little more. The month after that, you buy a little more. But I think long term, these are names that I know I definitely want to own. AI is going to have the greatest impact on productivity that the world has ever seen. I think the people that run these companies know what they're doing, and I would make a bet on them rather than my anxiety about the fact that they come down because they're spending too much money. They can always back off the spending if they want to.
Since we last talked, Joe, there's been, I would say, an intensification of all things AI on Wall Street. I look at a further intensification on all things robo-advisors. There was a company this week that is coming out with the ability that that AI creates stock research reports. As a former stock analyst, I mean, I can't believe it, but I guess I have to believe it. We're at that moment. How is AI changing the business of investing, and are you down with it? I mean, do you think it's a good thing?
Research that you would do to be able to kind of get ready for your program, or that you would have your team do. AI can really help with regard to that. When I want to know what happened in the last 12 hours of the war, I'll check with ChatGPT or Perplexity. There's going to be that's going to happen, but there's also going to be a reallocation of skill sets. So as you think about what kind of career path you want, those are some of the things you got to think about.
All right, we're going to leave it there. Joe, always so nice to see you. I appreciate the thoughts, and I suspect you're going to be right again on the Mag 7 like you always are. Joe Moglia, appreciate it. We'll talk to you soon.
All the best, Brian. Thank you.
All right, opening bid today was only a warm-up for me. Moments ago, I just dropped 2 new episodes of my Opening Bid Unfiltered podcast on Yahoo Finance, YouTube, Spotify, Apple, and Amazon. One is with former Tesla President John McNeil, who took me in the mind of Elon Musk, quite the mind to be brought into. And the other is Archer Aviation founder Adam Goldstein, who is planning to shuttle people to the 2028 Olympics in an eVTOL. And yes, this thing sort of looks like a helicopter. Interesting. And this afternoon, I'll be live with McCormick CEO Brendan Foley in his first interview since its huge deal for Unilever's food business last week. Almost hard to imagine Frank's Red Hot Sauce and Hellman's Mayo will be under one roof. That is wild. Julie's back next on Market Catalyst.
with Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's take a look at where stocks are going. Futures had been pointing to a bit of a sort of mixed open here. We're now little changed after the big rally that we had yesterday on news of a 2-week ceasefire that it already maybe is showing some cracks. There are some questions around it, and markets are trying to figure out where to go from here. Right now, the Dow's down about 47 points, the S&P 500 down about 0.1% as well. The Nasdaq pulling back a little bit more, about 0.25%, but still, we're seeing sort of modest moves across the board here. And just like we did yesterday, let's take a look cross asset to see the follow through from yesterday's moves. In the bond market, not really any. We're seeing the 10-year yield little changed here, 4.29% after the big decrease in yields that we saw yesterday. We continue, of course, to watch crude oil futures, which came down yesterday pretty dramatically, now making up some of those declines. WTI today is trading back above $100 a barrel, as we are hearing that there are still perhaps some attacks going on, at least from the Iranian side, and also that there has not been a full opening of the Strait of Hormuz. There are a few ships making their way through, but still definitely not anywhere near back to where the traffic was before the war. So continue to watch oil prices, and then we continue to watch Bitcoin as well, which we see pulling back a little bit today. And then looking in more detail in what's going on with stocks today, we have kind of, again, that mixed picture. Energy shares coming back up after being down yesterday, back up with oil prices. Utility stocks are also gaining some steam today, up about 1.7% as a group. Tech is weak today. Financials are weak today. Those are the two groups that are providing the biggest drag. And of course, because tech is the heaviest weight, that definitely accounts for a lot of the drop here today. Mixed picture as well when it comes to the actual tech sector. This is the NASDAQ 100 specifically. Palantir sticking out to me, down 7% today. It was down yesterday as well, even in an up market. We're going to talk more about that when we get to trending tickers a little bit later in the show. But let's look now once again at the big picture here, because both the U.S. and Iran have each accused each other of violating that ceasefire that was just announced. And ahead of planned talks this weekend, President Trump has vowed to keep troops in the Persian Gulf. Joining us now, Arianna Salvatore, Morgan Stanley Executive Director and Head of U.S. Public Policy Strategy. Arianna, I'm so glad you're here because, gosh, it's confusing what's going on out there for market participants. And, you know, we've gotten into this habit over the past couple of months of this war of sort of like being very headline driven, paying attention to what's going on. And I think there's a lot of confusion after yesterday. So what are you paying the most attention to try and get some clarity out of this murk?
Yeah, absolutely. You said it. Headlines are driving confusion. There's been whiplash back and forth, and it's easy to get lost in those very near-term signals. The first thing I'd say is we see this as a ceasefire pause, not a resolution to the conflict, and that's a really important distinction. In terms of what we're watching from here, I'd say three things. The first is the traffic at the Strait of Hormuz. That's a key issue in particular with the negotiations coming up this weekend. And that's really the clearest transmission mechanism for markets, right? That's what clients have been paying most attention to. So that's the first thing. We're still waiting on details, how many ships are coming in and out of the Strait. The second thing, as I mentioned just now, negotiations. They're going to start probably on Saturday, it seems, from some public reporting. Any sort of indication of how those are going, they seem to be anchored to that 10-point plan that Iran introduced, but any sort of red lines that are put out there by the administration will be critical. The third thing I'm watching for on the domestic front is gasoline prices. This, I think, will indicate the administration's level of tolerance or appetite to engage in those negotiations or pull back, right? That's a clear source of pressure heading into the midterm elections. Gas prices were somewhere around $3 per gallon heading into this conflict. Over the past month, we've seen it increase a little bit over $4 now. So consumers are starting to feel the pinch. That's why I think those are kind of the three most important metrics to keep an eye on from here, in spite of all the headline noise.
Yeah, and from what we know right now, does it seem like indeed this is going to be more than a pause, that it is going to be more of a, I mean, and it's not even a full pause, right? As we talked about, there's still also Israel is still attacking Lebanon. Iran has said that's a condition, that stopping is a condition of it agreeing to continued ceasefire. But are you feeling optimistic that this is coming to a close?
So I think it's important to have a degree of humility when it comes to predicting these sorts of outcomes, right? So much uncertainty. I will say, even at the start of the conflict, we said one of the key things to watch to indicate the duration would be a clearer calibration of the objectives of the conflict, right? And not just from the US side, but also with Israel, because that's the most important kind of strategic partner in this fight specifically. So looking at, if we're talking about a longer term engagement versus shorter term, that can be defined if we're talking about limited military strikes and military engagement versus something that might take a little bit longer, dealing with the nuclear program, limiting Iran's ability to fund proxies. Those sorts of things tend to take longer. So that's really all we can look at the moment. That's why it's so important to anchor to scenarios. And to that point, our oil strategists have laid out 3 different scenarios. This kind of middle point of ongoing constraints. Oil is somewhere around $100, $110 per barrel. That seems to be the world that we're in right now. And as long as the Strait is heavily limited in terms of traffic, I think that's probably where we're going to be. And obviously the feed through there is weaker economic growth, slightly higher inflation. We still think the Fed maintains its easing bias, but we've pushed out our expectations for cuts this year.
And you talked about the goals of this administration in Iran. They've thrown a lot out there. Yeah. Is it even knowable what the goal is and which of those goals they are going to pursue sort of most fully?
So they have defined, I would say, 4 key goals, right? So the first is limiting Iran's ability to fund proxies and engage with the rest of the region. The second has been military, in focus specifically, so missile launcher capacity being destroyed. The third is focused specifically on the Navy, right? So limiting their Navy assets. And the fourth is on this nuclear point. And nuclear is really the biggest unknown at this stage. We've heard some indication that the negotiations will focus on nuclear. But again, this is an area that's been tried and tested diplomatically for many years. Trump in his first term pulled out of the Joint Comprehensive Plan of Action. That was the Iran nuclear deal in 2015. We saw obviously a different route taken last summer with the strikes on the nuclear facilities specifically. So that's a really big unknown. But that's why, like I said before, one of the key things we're looking at to determine the duration of the conflict is which objective is most important and most paramount, because all of these objectives I just laid out are tied to different time periods, right? So some will be easier to achieve than others. And so that's really going to be a key indicator.
War aside, now that we at least maybe seem to be closer to the end than to the beginning, but we'll see. Maybe now the attention for you in public policy and politics turns to the midterms. Is that what you're now spending a lot of energy on? And then what are you watching most closely in terms of its relevance to markets and the economy?
So really hard to disentangle midterms from what's happening right now, I would say. And you see that even in prediction markets, which are now ascribing a higher probability of a Democratic sweep than we had even just a month ago, right? So I think when it comes to the midterm elections, the most important issue for voters will be affordability, cost of living. And if you remember just a few months ago, that was the biggest political issue.
Right.
The focus on affordability vis-a-vis housing policy, healthcare policy, energy policy, all of those things were top of mind. I do think that Congress and the president will pivot back in that direction once this conflict is largely in the rear view. But again, it's really hard to separate those two things because of the impact on gas prices, like I mentioned before.
Right, because if gasoline prices remain higher and, from oil analysts we've talked to, even if the conflict ended tomorrow and the Strait opens entirely, it'll take time for them to come down.
Yeah.
I mean, how do we sort of suss out how much that will affect the midterms, depending on the timing of how long it lasts, et cetera?
Right. It's hard to have a perfect rule of thumb here, but looking back at the past few elections, what we see is if you have an incumbent government and gasoline prices are something like $3 a gallon, that tends to be good for the incumbent. If it's somewhere around $4, it's politically more challenging. And then 5+, it just makes it really hard to win that election, right? So like I said before, we're in that yellow zone still, I would say, with still a little bit of room. The president has talked about measures to offset or mitigate that increase. We've seen most of those kind of employed at this point, but that's really the framework that we're using.
Ariana, thank you so much for coming in. I
having
really
me.
appreciate it. All right, let's talk more now about the broader market implications of the Iran war and where we are right now. Joining us for more, Michael Aroney, State Street Investment Management Chief Investment Strategist. Mike, it's great to see you. You heard what we were talking about in terms of trying to figure out what's going on here. The market kind of, like yesterday was kind of like, okay, we're done with this, we're going to move on. How much do you think that investors are still going to be headline focused now, or do you think they kind of are done with the conflict?
Well, they're certainly not done with the conflict. And I think this morning's reaction to some of that fragile peace or fragile ceasefire continues to reflect that. So I think the markets throughout this conflict have the belief that it will be short-lived. And I still believe that markets feel that way. But it has continued to be driven by headline risk. So I think we're moving critically, importantly, from kind of the threat of escalation to more of structured negotiations. But Julie, I still think that the market will be on edge, headline risk will remain high, and kind of tail risk will remain skewed to the downside. But overall, markets believe that a resolution is in sight. And I think that they continue to kind of, market action reflects that belief, that conviction.
And you know how these things go. Like this thing is over, and now investors want to know, okay, what's next, right? What's the next sort of catalyst that you think folks are going to be turning to figure out where things go from here?
Well, I think the big question is that there was a significant leadership rotation underway kind of towards the end of last year and early this year, prior to the war breaking out. And we saw that transition, or kind of transition from AI tech leadership to a broadening where international, emerging markets, small cap stocks, industrials, and other parts of the economy were actually closing that gap and became leadership. So I think the real question is if in fact a resolution is in sight, what takes its place going forward? And I do believe that there continues to be significant ingredients to suggest that rotation will kind of continue to unfold post whatever we get here from this ceasefire and potential resolution in the US-Iran war. So I think that will be the biggest question is, does that leadership rotation kind of re-exert itself, or do we get something different? And we think that rotation in leadership has a lot of strong underlying kind of structural underpinnings, and will likely come back once this resolution is potentially reached on the war front.
And just before we do, I want to dig into the rotation in sectors a little bit more, but first I'm curious, sort of from a backdrop perspective, how you're feeling about the economic underpinnings of all of this, right? We did get some economic data today. It's a little bit dated, but I was struck especially by the fact that GDP was only 0.5% in the fourth quarter. That was that final read. We got some February numbers, PCE still coming in. Headline at 3%, right? And that was before the effects or any feed through from higher gasoline prices. So, what does that look like? What does that picture look like for stocks?
Well, I do think that kind of at the end of last year, you could see, of course, we had the longest government shutdown in history. We had debates about kind of the private equity picture. You had a number of things. You had fears about the AI bubble. All of this contributed to a slowdown in the economy. And I think that's reflected in this backward-looking data or rear-view-looking data. Now, I think expectations were that the One Big Beautiful Bill Act, easier monetary policy, solid earnings growth would all stimulate the economy going forward. Now, Julie, I think what's happened is that the US-Iran war has thrown a little bit of a kind of a wrench into that assessment. So the longer the strait remains constrained, I think the fears of both inflation and a slowdown in the economy coexisting, kind of instead of offsetting each other, exist. And those stagflationary fears kind of fuel themselves. So I think that kind of, again, as we look forward, I think investors and market participants will be looking into the data to see if inflation's rising while growth is stagnating. Now, I expect kind of that when we look at this, when you talk about, hey, what's the next big catalyst? What should we look at going forward? Lost in all this discussion, Julie, is the fact that earnings are starting to trickle in. And next week, on Tuesday, when we get JP Morgan and Citigroup and Wells Fargo, that'll kind of start earnings season in earnest. And Julie, the numbers are expected to be outstanding. Earnings growth for S&P more than 13% on revenue growth of close to 10%. And those earnings expectations have been rising, and analysts haven't adjusted their full year forecast yet. So I think that one of the things that's kind of interesting here is that it's difficult to envision a stagflationary environment or an economic contraction with earnings growth at these levels and business fixed investment at these levels. So I think that'll be key going forward. Should the earnings come in as expected, boy, that's a big tailwind for the stock market.
we shall see if that's how it plays out. And I wanted to dig into the sectors for just a minute here, because I know that you like energy, which is really interesting to me because it's already outperformed so much. So especially if oil prices kind of come off the boil here, what's going to keep those stocks performing?
So, Julie, what's really interesting is that investors actually are overlooking the fact that energy shares were rising before the conflict broke out at the end of February. So a lot of this was kind of viewed as a potential cyclical upswing in the economy, lighter regulation. The companies have demonstrated capital discipline in terms of their spending, and they've had a fair amount of innovation when it comes to exploration and production. So that was already happening, and the shares were responding. Now, all of a sudden, after years of focusing on their efficiency and doing more with less, now, given the higher oil prices, their revenue outlook has improved. So we were expecting virtually no earnings growth from energy companies. Now it's close to 10% at a time where I can buy them for a far lower multiple than the market from that perspective. So those kind of items were already driving energy shares higher prior to the conflict. And now all of a sudden their revenue outlook looks a lot better. And I think that's kind of the primary catalyst for why we've upgraded the sector.
And then quickly, Mike, the other area I wanted to ask you about is tech, because the sort of sentiment around tech going into the war was not great, right? We had obviously seen a big software sell-off. We had seen a lot of questions about AI spending and a lot of questions about AI sentiment overall. So why do you think that tech is, do you think that any of those factors have changed, or just they've been priced in?
So what's been interesting here now is we're expecting 45% year-over-year earnings growth on technology and 27% revenue growth year-over-year. Technology, due to that multiple compression, now trades for just 23 times forward earnings. The market itself is trading at 21. So I can buy incredible earnings and revenue growth at a time when economic growth may be slowing and inflation may be rising for roughly a market multiple. And when we think about all of the things that are going on from a geopolitical and economic perspective, we think in many ways the technology sector is insulated from a lot of them. Now, I get it, right? You'll ask me about the capital infrastructure build on AI, and doesn't that require a lot of energy and things like that? Of course, there is those components, but overall, we think the business fixed investment there, the earnings growth, the revenue growth, and the fact that I can buy this for roughly a market multiple makes technology really attractive right now.
Mike, thanks so much. Good to see you.
Thanks, Julie.
Coming up, how lower drinking rates and higher gasoline prices are continuing to affect Constellation Brands' bottom line. We'll be right back. Let's get a check on cryptocurrencies brought to you by the National Cryptocurrency Association. We have, once again, cryptocurrencies following stocks or following the general risk-off sentiment. Just like we saw a rally yesterday, we are now seeing crypto come off a little bit along with stocks, other assets that are concerned about maybe the sustainability of this ceasefire and what's going to happen also with interest rates going forward, even as we also got PCE numbers for February that showed headline inflation still rising 3% year over year. We've got Bitcoin off about 1.25% today. Ethereum is down. So mostly some declines here. We've also got some interesting moves within crypto stocks. Again, most of them rallied yesterday, and many of them are falling today. Robinhood and Coinbase, most notably, have resumed their pullback. As I noted yesterday, these are some of the worst performing stocks this year, particularly in the financial industry. A couple other movers to point out as well. Bullish getting an analyst downgrade today, and those shares pulling back some 7%, and Applied Digital down by about 8.5%. There's the 2-day chart. If you look at the 1-day, you've got that drawdown here. That company came out with some numbers, and there's some concern over gross margins in particular at that company. You can see the shares year to date still hanging on to a small gain, but that's where you see some of the darker red here. Circle also pulling back by some 7%. Some of the other crypto related stocks are trading a little bit higher today. Well, a report in the New York Times claims to have uncovered the creator of Bitcoin, Satoshi Nakamoto, saying it's Adam Back, Blockstream co-founder and CEO. And Adam is joining me now. Adam, this is not the first time that someone has said that you are Satoshi. This person was John Carreyrou, who is a well-known journalist who broke the Theranos story about Elizabeth Holmes, wrote a book about her. And I'm curious about the experience this time of having him dig in. He looked at your language. He met with you several times. What did you make of his methodology in this investigation?
It was really kind of data science based, right? They looked through a lot of old posts and tried to find similarities in writing styles or topics of interest between people working on Bitcoin-like things before Bitcoin and Satoshi. So I think there's an element of confirmation bias in that, because you are inherently pre-selecting people who are interested in similar things. They're programmers, they're interested in privacy, in cryptography, and so they're going to have similar language backgrounds and things like that. So of course they're going to sound similar superficially, right? So I think there's some of that, plus a lot of sort of circumstantial and common grammatical mistakes and things like that.
I mean, as I said, you yesterday after this came out, you tweeted that you are not, in fact, Satoshi. You have said this in the past in interviews also. Why should folks believe you that you're not? Because, it's for this long, Satoshi has retained his or her anonymity.
Yeah, I mean, I think that it's probable, so I think I was the first person to receive an email from Satoshi in August 2008, because he was citing Hashcash, the proof of work system I designed a decade or so before Bitcoin. And I think that, you're going to have sort of people are going to be interested to try to guess who this is. It's a fascinating kind of backstory. But Satoshi actually left the space, I think, in about 2011, 2012, stopped participating in forums. So if you think about it, the digital footprints, the breadcrumbs of the different forum posts that he had made dried up, 14 years ago now or something like that. And so a lot of people have looked over that data to try and figure something out. So as there's no new data, I think that, nobody's found anything conclusive, that I think all that's really left is kind of, speculating and language analysis about people involved. But I think the most probable situation is that Satoshi is somebody, who's not talking to documentary film crews, to investigative journalists, and who's not participating in the forums or at conferences with his real name. And so it seems probable that we'll never know unless, there's some inheritance event in the future and some younger people with conspicuous spending habits, or the quantum topic, right? That maybe he will have to move his keys, move the coins, if these digital signatures need to be upgraded in the future.
Adam, do you have any kids?
I try to keep family out of this kind of topic.
Okay. Well, if we're looking for inheritances, I was just curious. I am curious though. Speaking of which, unfortunately, within the crypto community, there have been some instances even of kidnappings, of violent events. And so, with a piece like this coming out, have you had to increase your own personal security?
It's certainly something to consider. And, I think a number of people in the industry have started to pay more attention to security for senior staff when traveling and things like that. So, yeah, it's a consideration.
Adam, do you have your own theory of who Satoshi is or was?
Well, I think the starting point is not unreasonable that you would look based on the skill set because, Satoshi's a programmer, he knew about cryptography, had the interest, the skill set, and that's a somewhat specialized skill set. But, of the different people that have been speculated on, there seems to be reasonably indications that it's not them. So, from what I can tell, we don't know, like nobody knows. And so, as I say, I suspect that we're probably never going to know unless something changes, right?
Do you think it matters who he is?
Well, I think it's actually, positive and fortunate for Bitcoin for whatever reason that Satoshi stopped participating in the forums, because I think it helps Bitcoin seem more like a discovery and an asset class and less like, a company or a startup with a CEO, because Bitcoin is a sort of neutral global digital asset and a form of savings, which is harder to contemplate when there's a character at the front. So if you think about like an Elon Musk or with a Linux operating system, or Linus Torvalds, there are people at the helm of those who are opinionated, vocal people. And of course, a lot of the world thinks hierarchically, so they would want to, ask that person opinions or ask them to change the system. And I think Bitcoin benefits from being, truly decentralized and chaotic. There are hundreds of developers, thousands of companies, lots of different financial firms at this point with Bitcoin products and indeed sovereigns, the Swiss National Bank, the Abu Dhabi Sovereign Wealth Funds, El Salvador, some US states who are building Bitcoin positions. So it's really helping it to have that kind of global neutral monetary concept.
And Adam, I'm curious whether or not you are Satoshi. You are somebody who is a believer in these tenets that underpin Bitcoin. Certainly, Hashcash, as you talked about, that was something that you came up with early on. As this decentralized system, as a way to retain privacy of the user. And as it has expanded more into this asset class, you've had, and even early on in its life, it did attract folks who were on the wrong side of the law in some cases, but also has attracted a lot of opportunists into the system. And I'm curious, as someone who is sort of a true believer in it, do you think that some of that involvement has sort of polluted the initial conception of this as an idealized financial system?
Yeah, of course, you will have opportunists in everything. The early internet involved a lot of spam and nuisance uses, right? So you get that, but I think it's a very different asset class, somewhat decorrelated, and provides much more sort of self-sovereignty to the individual, as opposed to conventional banking or fiat currencies like the US dollar, the euro, which are subject to kind of moral hazard in times of financial stress, where there's effectively been a big percentage of, for example, US dollars or euros that have been printed in the last decade. And that is, directly eroding your spending power as an individual. So while Bitcoin is volatile, it has a much more predictable and mathematically assured rate of supply, sort of more akin to gold, in fact.
But I guess then the risk would be, like the risk could be in any currency as well, not necessarily designer risk, not fiat risk, but user risk, like who's your counterparty, for example, on the other side of the transaction, right?
Yeah, I mean, I think it's more like a bearer asset, which is a relatively rare thing in the world. But I guess effectively gold is that, right? So in some countries, some cultures, people are saving in physical gold. They buy gold jewelry or gold bars, gold coins, and those are pretty fungible, interchangeable, and even fiat cash is fungible by sort of de facto by law that $100 bill is equivalent interchangeable with another one and doesn't really bring with it a history and an audit log of who held it before and what the purpose of the prior transaction was.
Right. While I have you, Adam, I want to ask you about something that there was a lot of excitement about yesterday in the crypto world, and that is Morgan Stanley being the first sort of big Wall Street bank to enter the ETF space, the Bitcoin ETF space. It has a new spot ETF product that's competing with the existing products out there like IBIT from BlackRock, and they're coming in at a lower fee structure. And there was a lot of excitement over this. I'm curious how closely you were watching that and what the significance of that is for the ecosystem.
Yeah, I mean, I think, while the ETFs are not, physical Bitcoin in a wallet, they are a form of access. It makes it easier for people who manage their savings by calling a broker or using a brokerage account. And so for Morgan Stanley users, now it became a lot easier, right? And they have their own network, their own huge client base, and you can see it in the numbers, right? So by the end of yesterday, they bought about as much as the mined coins. So almost 450 coins in the first day, which is a very strong start. So, I think there's a new buyer in the market, the Morgan Stanley clients, and that may in fact grow, plus of course other institutions that might choose to allocate to the Morgan Stanley ETF. So there's also competition at the fee level with IBIT and the other providers.
Adam, really appreciate you joining me here today, especially after that big story came out. So we'll definitely stay in touch on all of this. Appreciate it.
Thank you.
Coming up, we'll bring you today's top trending tickers and one Michael Burry may or may not be shortly. time for some of today's trending tickers. We're watching Palantir, CoreWeave, and Meta, and BlackBerry, and Jake Conley is with me now to talk about these. Let's talk about Palantir first of all. Now, it's interesting. The stock was down yesterday. Even when the market was up. It's down again today. So down about 6% yesterday, down about 7% today. And Michael Burry, well-known investor.
Famed investor.
He has already, sort of come out negatively on the stock in the past.
Right.
And then he seemed to re-up, but then the tweet was deleted. Like, what happened?
Took the post down, it seems. It's also, it would be very out of character to see Michael Burry back away from a position.
That's right.
He's known for sticking to his guns,
yes.
right? And this is not a new position, as you point out. He published the fact that he's short on Palantir back in September. In pretty relative size, he's been very critical of Alex Karp and Palantir since then. So it was a bit of a shocker to me to see him seemingly back down. Now his argument is that Palantir is going to lose some of their government and military market share to Anthropic. Obviously, Anthropic is in its own battle with the Department of Defense, Department of War right now. But notably, the Anthropic software, Claude, was the first major AI model to be embedded in classified operations. We saw it used in the Venezuela raid that took out Nicolas Maduro. Palantir has the history here. They're deeply embedded throughout the military. But it's just weird to me to see Michael Burry back away from a call.
Right, that he came back. I mean, and who knows what happened behind the scenes, but it is also interesting that the stock is still down as sharply as it is.
Right.
So, that part, like with anything with these stocks, like some of it is probably maybe fundamental, but a lot of it is positioning. Yep. How much is the stock shorted? How much, where do people stand on it?
And you see people pointing out that a lot of algorithms are now tuned just to trade off whatever Michael Burry says. Right. If Michael Burry puts out a post that's even mildly bearish on Palantir, a bunch of algorithms are going to sell off.
Right.
Just automatically.
So yes, there's definitely at least a little bit of that going on. All right, next up, let's talk about CoreWeave and Meta. They are expanding, or it's a new contract, but it's an expansion of the relationship with $21 billion. That's right. And this, we were talking this morning, Miles Udlin and I, about this is like sort of back to regularly scheduled programming. The war seems to be winding to a close, or at least a different point. And so now we've got all these kinds of announcements resuming.
Right. This is the resurgence of tech that the market's been waiting for, right? You see some of these deals getting signed. As you point out, this is not new for CoreWeave and Meta. It is coming, though, notably right after Meta just released its new superintelligence AI model, new Spark. I've seen some strategists making the very smart point that Meta's been spending a lot of money. They've been spending money on talent. They've been spending money on compute. And it feels like they're still kind of just barely keeping up with Google, with OpenAI, with Anthropic. So does this deal with CoreWeave, does the expanded compute capacity allow them to stay being a dog in that fight? I think that's what they're hoping for. The market certainly liked it for CoreWeave.
Well, and this at a time when it's becoming more obvious, like people are running up into limits in some of these models, right, on their usage. And so I think it's becoming even more clear to just the layperson user the limits of compute.
There are hard limits here.
Yeah.
This is, you hear about the AI infrastructure. That's not only electricity, which you and I talk about all the time, but it's compute capacity.
Right.
Can you get chips? Can you get data center availability and access? Also, I think worth pointing out, a lot of CoreWeave's data centers are run off NVIDIA chips. All roads lead back to NVIDIA.
Yeah.
But to your point, it's not just the tech people who are saying there are going to be limits here. The wider retail investor base, everyone's realizing there are hard limits, and they're spending a lot of money when we don't know if demand is going to show up. We've been kind of assuming it is.
Well, demand is already there. So the question is how much more demand will grow, and that assumption is that sky's the limit.
It's
I suppose.
exponential, right?
Yeah,
which I think it's certainly an assumption to make.
Well, here's one thing that seemed intractable, right, when it was all the rage: the BlackBerry. BlackBerry's still around. The company is still around, although the company doesn't make BlackBerries anymore.
Not a phone company anymore,
it's
really.
more sort of a security and software company. And the shares are higher by 12% here this morning.
Yeah, good earnings. Beat on revenue, beat on adjusted EPS, forecasting fiscal 2027 revenue above expectations. This was a great quarter for BlackBerry, you've seen them over the last few years, the stock's been kind of floundering. They brought in new management, and I was reading through the earnings call this morning. I want to quote from here.
Yeah.
The CEO, John Giamatteo, says, "We promised to turn around to transform BlackBerry into a profitable growth company, and I'm pleased to report we've done exactly that. The turnaround is complete. BlackBerry is now a growth story."
Okay.
And it's the AI argument.
I mean,
right?
it's today it's trading like a growth story.
Right.
We'll see if that continues.
It's the AI argument. They're in cars with the QNX business, what they call it, for embedded AI. This is cars. They announced a deal with Johnson & Johnson. They're powering I want to get this right, an AI-driven heart pump that Johnson & Johnson is operating. So BlackBerry's moving into what we think of as the physical AI space, right? Embedded technology. They were talking a lot about robotics on the call and wanting to get ahead of that as the next kind of frontier of what we can do with AI. And for BlackBerry, obviously they have the software side, the communication side, but it seems to me like the management is really trying to lean into the AI story and try to, hitch their wagon to that one.
Right. I wonder if they change their name at some point.
You think they
There is. I mean, I wonder if I still have I was just thinking. I wonder if I have a BlackBerry still in a drawer.
My dad has one laying around that he hasn't used in 10 years, but it's in a shelf somewhere.
It's in the tech graveyard.
Exactly.
In, the house.
In that bin right in the kitchen. Yeah.
Thanks, Jake. Appreciate it.
Thanks, Julie.
Coming up next, Yahoo Finance's Market Madness is reaching its climax, and we'll tell you about the latest matchup next. We have reached the business end of Yahoo Finance's Market Madness tournament. It's the Final Four, and despite the shocks and upsets along the way, the remaining companies will come maybe at no huge surprise. The Final Four: Alphabet, Walmart, Amazon, and McDonald's, all vying for a ticket to the final. Let's focus on the right side of the bracket, and joining me is James Dammer, Main Street Research's Chief Investment Officer for Market Madness, brought to you by Everpure. Those who were sad that basketball Market Madness were over, March Madness was over, we've got you. So James, so we're taking a look here at Amazon versus McDonald's. Obviously, two very different companies, both very compelling stories. Which do you find more compelling?
Good to see you, Julie. You have to lean way into Amazon here. These are both exceptionally great companies, but I think investors, and this is my message to investors, look at what you think the economy can do if the Strait of Hormuz is open, which we think it will be, and which of these is going to be the real leader. And without question, it's Amazon. They're both trading at the same PE multiple, but you're going to get a ton more growth out of the Amazon play.
Yeah, that's pretty surprising that their PE is similar at these levels. Not necessarily what you would expect here. Let's dig into Amazon a little bit more here, especially since this company's CEO, Andy Jassy, just out with his annual shareholder letter, and he really dug into the business and all of the different areas that they're in. Obviously, it's a very diversified business. I was struck, James, by the section where he talks about the company's chip making and that it's now at a $20 billion annual run rate. He talked about offering a cheaper alternative to NVIDIA chips, although he says we're still using NVIDIA chips for clients of AWS, but we're also making our own. Kind of how do you think about those different business lines and what you find most exciting there?
Yeah, and that's a great point. Jassy talking about expenses. That's where investors get nervous, right? How much money are they going to throw at trying to design and manufacture their own chips? It makes sense in the long run, but in the short run, it can spook investors. What I think is really important for investors, since we specialize in individual stocks at Main Street, is look at the AWS business that's part of the biggest part of Amazon. And that is growing at such an incredible rate. I think it can absorb the expense that's going to go down on trying to develop their own chips. And I love that he said, we're still wedded to NVIDIA. I think that was very important for investors to hear that. But that, that big deal they have with OpenAI, a $50 billion deal, tells you that, AWS part of the business model is extremely robust.
Amazon, like many of its big tech peers, has been hit. It's down now a little more than 2% this year, so it's not a huge drawdown, but it's more of a drawdown from its highs. And sentiment around big tech, even before the Iran war, was not great, right? There were a lot of concerns about software, concerns about spending, concerns about AI adoption generally. Where do you think we are on that, and how do you think Amazon and some of its peers, for that matter, sort of come back from that?
Yeah, it's, the stocks, the whole AI trade has been asleep. And what happened to the AI bubble that we were all worried about? The air has slowly come out over the last 4 months. And at Main Street, we think that is a tremendous value play. It's so unusual, and you might remember the 90s, you're probably too young, the 90s big tech cycle. We had just a handful of pauses like this, and they were all windows of opportunity. So we think that Amazon here is a value play in the non-infrastructure AI play, meaning you're getting away from the chips like the NVIDIAs and the ASMLs and the Taiwan. If you go to that next generation, I think Amazon's great position here. The PE's contracted over 4 months. Nobody seems to be interested. That's when you want to go.
Just one final here on McDonald's to take the other side of it and dig into that a little bit more. I mean, McDonald's has gotten a lot of attention lately after its CEO ate that burger on camera. And, it feels like that there is some enthusiasm around the stock that, if people are looking for value, maybe they're turning to customers, that is, or turning to a place like McDonald's. So how are you thinking about that thesis around that company?
The CEO eating that stuff every day is so amazing for the brand, what a CEO will do. That's just fantastic. And I think McDonald's, as I said, it's a great company. But, again, this is a world of choice. And if you think the economy is going to have a tough road over the next 3 or 4 quarters, this is a company that has tremendously consistent growth and profitability. That's why it trades at a relatively high multiple to its growth rate. So I can see why investors would say, well, you know, this is a safer play. I know those earnings are going to stay consistent no matter what. In our view, I just think that's a conservative stance, maybe as a part of the portfolio, but I wouldn't do a whole lot of that.
So in general, James, if I'm reading between the lines here, it sounds like in general you are sort of more growth oriented right now than you would be looking sort of defensively positioned.
Yeah, we think the economy going into the war was in great shape. We had great productivity growth, we still do. And we think earnings over the next few weeks, here they come, are going to be way better than expected. And we'll get past this big oil jolt, and the market goes to new highs by the end of the year. It's going to be led by the real growth stories, not necessarily the McDonald's, but more of the Amazons.
We'll talk to you again soon to see how that's going. James, thanks so much. And you can stay with Yahoo Finance to see who will meet Amazon in the final. Alphabet taking on Walmart. That's coming up Friday on Market Domination to determine those last two. That is it for Market Catalyst. I'm Julie Hyman. Thank you for watching. More Yahoo Finance is coming up.